Have you ever wondered why some countries that tax the rich heavily end up collecting less revenue than expected? Consider this. In France, the introduction of a wealth tax caused over 12,000 millionaires to leave the country, taking their businesses and investments with them. The result? Billions of euros in lost revenue and thousands of jobs gone. But France isn't alone. Sweden, once known for its high taxes on the wealthy, scrapped its wealth tax after realizing it was crippling investment and innovation. These countries thought they could close the wealth gap by increasing taxes on the rich, but instead, they watched their economies take a hit. So what's going wrong here? Welcome to Satoshi Finance, where we break down complex finance topics to educate and empower you on your journey to financial freedom. In this video, we're diving into the economic impact of taxing the wealthy, exploring real-world case studies, and uncovering why this approach often backfires. Stick around to find out why overtaxing the rich could be one of the worst financial strategies a country can adopt. Taxing the wealthy heavily can lead to a significant reduction in investments in businesses. Wealthy individuals, including entrepreneurs and business owners, often play a key role in funding startups and expanding existing businesses. These investments are crucial for job creation, economic growth, and innovation. When tax policies target the rich with high rates, it can discourage them from reinvesting their wealth into new ventures or expanding their current businesses. Instead, they may choose to move their assets abroad or reduce their risk exposure, resulting in a decline in available capital for the economy. Additionally, overtaxation can stifle entrepreneurship and innovation. Many successful business ventures begin with wealthy investors taking risks on new ideas. When taxes are too high, these investors may be less willing to fund risky but potentially groundbreaking projects, leading to fewer opportunities for innovation. In the long run, this can slow economic growth, reduce competition, and limit technological advancements, all of which are essential for a thriving economy. The rich are often seen as engines of growth, and by reducing their incentive to invest, overtaxation can have a detrimental effect on the broader economy. France's implementation of a wealth tax is a prime example of how taxing the rich can backfire. The tax, aimed at reducing wealth inequality, instead led to a mass exodus of wealthy individuals who moved to countries with lower tax rates. As a result, France saw a sharp decline in tax revenues and job losses, as these individuals often took their businesses and investments with them. Over 12,000 millionaires left the country between 2000 and 2016, leading to a decrease in the capital available for economic growth and a reduction in overall tax collections, making the policy counterproductive. Similarly, Sweden experienced the negative effects of high taxes on wealth and inheritance for decades. The country eventually abolished its wealth tax in 2007 after realizing that it discouraged both savings and investments. The tax had pushed wealthy individuals to relocate their assets abroad, draining the economy of much-needed capital. The removal of the wealth tax was a recognition that encouraging investment and entrepreneurship was more beneficial for long-term economic growth than taxing the wealthy heavily. The United Kingdom's experience with the super tax in the 1970s is another cautionary tale. With tax rates as high as 98%, many wealthy individuals fled the country, resulting in a significant loss of potential revenue. The expected windfall from taxing the rich never materialized, and instead, the UK faced lower than anticipated tax collections and economic stagnation. The policy ultimately hurt the country more than it helped, proving that overtaxation of the rich can lead to unintended consequences. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Wealthy individuals play a crucial role in job creation, as they are often business owners, investors, or key stakeholders in large corporations. Their financial resources are typically used to fund new ventures, expand existing businesses, and create jobs. When taxes on the rich become too high, these individuals may move their wealth to countries with more favorable tax environments or use legal methods to hide their assets. This results in less capital being available for investment, leading to reduced business growth and, consequently, fewer job opportunities. High taxes can also force businesses to make difficult decisions. Companies may cut jobs, freeze hiring, or even relocate to countries with lower corporate tax rates to protect their profits. This not only leads to unemployment, but also harms local economies. A clear example is large corporations moving their operations abroad to avoid high corporate taxes, as seen with companies relocating to countries like Ireland or Switzerland, which offer more attractive tax environments. These relocations can drain domestic economies of both jobs and tax revenue, illustrating how taxing the wealthy can ultimately harm job creation and economic stability. Capital flight happens when wealthy individuals transfer their assets to countries with lower tax rates to avoid high taxation in their home country. This exodus of capital can have severe consequences for the home economy, as it reduces the amount of money available for investment in local businesses, industries, and infrastructure. When the wealthy move their assets abroad, it means less capital is being circulated in the domestic market, leading to a decrease in job creation, reduced spending on goods and services, and overall economic stagnation. The economy becomes deprived of vital resources that could have been used to stimulate growth, support innovation, and boost employment. A prime example of capital flight is the movement of wealthy individuals to tax havens like Switzerland, Monaco, and the UAE. These countries offer much lower tax rates, making them attractive destinations for the rich seeking to protect their wealth. As more assets flow out of high-tax countries and into these tax havens, local industries and workers suffer from reduced investment, shrinking the tax base, and ultimately leading to lower government revenues. This shift not only weakens the home economy, but also highlights the limitations of high tax policies on the rich, as they can easily transfer their wealth elsewhere to avoid excessive taxation. The wealthy often have access to sophisticated resources such as skilled lawyers and accountants who help them find legal loopholes to minimize their tax burden. These professionals specialize in navigating complex tax codes, allowing the rich to exploit gaps and ambiguities in the law. As a result, instead of paying the higher taxes intended to reduce inequality, the wealthy can often avoid them altogether. This undermines the effectiveness of tax increases, as the rich are able to legally shield large portions of their income and assets from taxation. The intended goal of raising revenue from the wealthiest individuals often falls short because of these practices. Global tax havens play a significant role in facilitating tax avoidance by offering wealthy individuals and corporations the opportunity to relocate their assets to countries with little or no tax. Nations such as Switzerland, the Cayman Islands, and Bermuda are well known for their favorable tax policies, which attract trillions of dollars in capital from around the world. This capital flight can have a substantial impact on the home country's revenue, as it erodes the tax base and deprives governments of funds needed for public services and infrastructure. The existence of these tax havens highlights the challenge of implementing effective tax policies for the rich, as they provide an easy escape route for those looking to avoid paying higher taxes. Rather than imposing high taxes on the wealthy, a more effective approach would be to encourage them to reinvest their profits into the local economy. Offering incentives for investments in startups, infrastructure, and small businesses can channel wealth into productive areas that spur growth and job creation. By providing tax breaks or credits for investments in specific sectors, governments can foster innovation and economic expansion while still benefiting from the contributions of the rich. This approach not only keeps capital circulating within the home economy, but also creates new opportunities for business growth and employment. Another alternative is to reform tax policies in a way that promotes fairness without stifling economic growth. This means creating a balanced system that taxes wealth effectively, but does not penalize success or deter investment. A key component of this is closing loopholes that allow the wealthy to avoid paying their fair share while maintaining reasonable tax rates that don't drive capital abroad. By focusing on loophole closure and ensuring that tax policies do not disproportionately impact job creators and investors, governments can strike a balance between generating revenue and promoting long-term economic growth. This balanced approach helps to ensure that wealth is both fairly taxed and actively invested in the economy. In conclusion, over-taxation of the wealthy can have far-reaching consequences that harm the broader economy. High taxes on the rich often discourage investment in businesses, reduce job creation, and stifle entrepreneurship. Additionally, as we've seen in countries like France and the UK, these policies can lead to capital flight, where wealthy individuals move their assets abroad to avoid higher taxes. This deprives local economies of crucial investments and reduces tax revenues, ultimately creating more harm than good. The wealthy have the resources to find tax loopholes or relocate to tax havens, making tax hikes less effective in generating revenue and addressing inequality. Given these challenges, it's important to rethink how we approach wealth inequality. Instead of focusing solely on taxing the rich, we should explore other methods that encourage investment and foster economic growth without driving wealth out of the country. This leads us to a thought-provoking question. Is there a better way to bridge the wealth gap than taxing the rich? Let me know what you think in the comment section down below. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.